the farm, which I was today, Caroline's farm, but unfortunately not, but sometime soon, I hope. Absolutely delighted today to be co-hosting with Scottish Agritourism and Johnston Carmichael this webinar, and great that you can join it. Obviously, we've had budgets in Scotland and we've had budgets in the UK government, all of which have significant bearing on our future outlook, particularly for the tourism sector. We're still in challenging times, as everybody knows, but there is light at the end of the tunnel, and I think we have to take the positive with that. And certainly the messages that continue to come from ministers and others that I'm personally involved in conversations with would suggest that the indications of perhaps an earlier start date than what was signalled a couple of weeks ago might be very possible. But that said, we as a sector group, our council and the Tourism Task Force have made it very clear that the industry is still in a very precarious position in terms of financial resilience. And this morning I was actually involved in a conversation with the chief economists of Scottish Government, which again highlighted some fairly telling statistics that 35% of food, hospitality and food service businesses in Scotland are in severe to moderate risk of going insolvent in the next 3 months, and 43% again through the ONS data gathered have less than 3 months cash reserves. So, you know, critically for us, it's all about trying to make sure that we are able to get the best out of any fiscal change. We've been fortunate, of course, in Scotland to get some benefits around business rates and other news, but there's always this grey area of how does this UK budget translate over into a Scottish budget situation, and I know we're going to get some clarity around that today to hopefully make it easier for us as an industry. But I'd first of all again like to thank Johnston Carmichael for their support of this event, and once again appreciate you all joining us today. And on that note, I'm going to hand over to Jenn Stewart, the director, who will chair the rest of the meeting. So thank you, Jenn.
Good morning, and thank you, Marc. Alex, are you able to share the slides?
Yeah.
Thank you. So we are delighted to be delivering this post-budget webinar to you all this morning, and again thank the Marc at the SDA and Gillian and Caroline for all their help. So next slide please, Caroline. So I am Jenn Stewart. I am a director with the firm and have the privilege to lead our team in Dundee. I'm both a rural and a restructuring specialist. And as a licensed insolvency practitioner, I have significant experience advising individuals and businesses of all types and size in the rural, hospitality and leisure sector. And I spend a great deal of my time helping businesses restructure and regain control of the business and actually avoid any formal insolvency processes. So your sector's been dealing with huge disruption caused by this global pandemic, you know, with a large number of your businesses shutting their doors and it being unclear when you were going to be able to reopen. But hopefully that roadmap is becoming clearer and you will be able to open sooner, as Marc has suggested. But obviously managing operating costs in a low revenue environment and availability of capital will perhaps have been two of the biggest challenges for your businesses of late. But like we said, that glimmer of light is hopefully there. So before I pass over to Alex, Tony and David, who are all excited to present you this morning on the post-budget tax, VAT and some financial planning aspects, I thought it would be useful to just take the opportunity to tell you a little bit more about Johnston Carmichael. So from our beginnings in rural Moray 85 years ago, we've grown into one of Scotland's leading professional service businesses with a network of offices across Scotland, 12 in Scotland and actually 1 in London. And as Scotland's largest independent firm of chartered accountants and business advisors, we're ranked as one of the UK's top 20 accountancy firms. And we've also got our international capability as a member of the BKF network. So we act for an excess of over 16,000 clients, and circa 2,000 of those are agribusinesses, and a further 1,000 are food and drink and hospitality and tourism related businesses. And these being wide ranging from individuals, sole traders, partnerships up to large corporates. And given our size and scale, we'll be on hand to listen and advise our clients at any stage. And we're a very sector focused business, and this really ensures that we've got the right team of people on board advising the client. And it's really reflected in the team we've got delivering the webinar today, all of whom have key expertise in this sector. Next slide, please, Alex. So as a full service firm, we really thrive and pride ourselves on client service. Each client has a client relationship manager dedicated to them to ensure that they're looked after and that our specialists are brought in to assist when required. And you'll see from the services that are up on the screen there that we look after business advisory. So actually a one-stop shop integrated service that takes care of all your client needs. We have our audit, we have our corporate finance assisting clients in buying and selling businesses of all types and raising finance and providing that business planning support. Our tax team, essentially, we cover all your usual tax, but also all the innovative taxes, likes of your research and development and your capital allowances, which might be relevant to some of yourselves. Again, our payroll teams have been extremely busy helping clients administer the furlough schemes and the job retention scheme. And again, looking at our Johnston Carmichael wealth, and you'll hear from David a little bit later, but again, helping clients plan for their future. They want to essentially be providing financial planning, because succession really is a key area for both wealth and our tax teams. And we have our restructuring and our consulting teams. And essentially they're helping businesses and individuals when something fundamental does have to change, often to help them cope with financial stress. Next slide, please, Alex. So I'm going to finish up with just a few top tips on really planning ahead before I hand you over to Alex. And essentially, timing of recovery is incredibly challenging for the sector to predict, particularly as there have been many further setbacks along the way, despite the difficulties in producing, meaningful projections in light of the current uncertainty. But businesses should make efforts to forecast their future cash flows and run several scenarios to help their lenders understand any risks. Also, across many businesses, we've had to implement and update health and safety procedures, especially with regards to cleaning processes and techniques. And it's likely that these associated costs are here to stay, and working these into future cash flows is therefore really essential. Now, booking activity, again, is likely to be significantly below average. Therefore, a prudent approach to forecasting and management decisions is essential. And again, being mindful of taking customer deposits. Many businesses have utilised customer deposits for working capital purposes and are being forced to return deposits due to cancellations. So again, this may see cash reserves running dry. Again, with travel overseas potentially being restricted further into 2021, the popularity of staycations will continue to rise. It's quite important that your marketing essentially reflects that, and that you really look to target that homegrown local audience until restrictions ease, to allow that international audience to come back to the fore. And it's critical to really regularly assess your offering. Strong consumer awareness and a differentiated approach are important. And it's vital to try and review your overheads and look at how you can actually drive forward new revenue. So we will try to run a short question and answer session at the end. However, if we run out of time, we'd be delighted to follow up with any questions following the session. So please don't hesitate to get in touch. So without further ado, I will pass you over to Alex Docherty, our Head of Private Client Tax. Thank you.
Afternoon, everyone. Thanks for having us here today. So I'm going to whiz through what were some of the main changes in the budget, the UK budget, and also flag up ones that I thought you guys might be interested to know a bit more about. I've got a fair few slides, so I'll probably not hang around. And if there is a slide that ultimately you've more questions on and want to talk more about, happy to do that. You know, this was a budget we'd all been waiting for. It was postponed back in the autumn, and I know certainly amongst my client base there was a lot of frenetic activity in the lead up to it, as clients were worried about capital gains tax rates rising and locking in at, you know, lower tax rates essentially. But what we ended up getting was actually quite benign in terms of capital gains tax and inheritance tax, not much change there, rates staying flat. And even on the personal tax side, getting a pause on the increase of bans and allowances. And where some of the more interesting things have arisen, it's around investing in businesses and how to unlock that checkbook and get the UK spending again. What Marc from Scottish Tourism Alliance has said is very true. It gets very complicated when you live here in Scotland, actually understanding what parts of the UK budget apply or don't apply to you here in Scotland. And as we go through this, I've flagged up where I'm maybe mentioning England only, and I've highlighted the Scottish equivalent, where there is a Scottish equivalent. But as you'll know, you know, monies that have been provided latterly by the Scottish government, a lot of those schemes as such are coming to an end or have came to an end. And I know that Marc and his team have put together a case for, you know, support as we start to exit from this pandemic. So no doubt we'll see more to come on that. We have had a Scottish budget back in January, and again there was the welcome news that the business rates would be extended. So without further ado, I'll rattle through the UK side of things. So the personal allowance, you know, he's kept his manifesto pledge, and he has not increased income tax rates or national insurance rates. We're seeing a slight lift to the personal allowance to £12,570 from the 6th of April 2021. Then that's going to stay frozen until April 2026. So as our incomes rise, one hopes over the next few years, we're going to see more of that income taxed as that tax-free allowance stays static. In terms of then the tax bands, again, these are being frozen until April 2026. And I've just highlighted there what those bands are. So basically you can earn just over the £50,000 when you take the personal allowance into play and be taxed on that at a 20% tax rate. Now, what you have to remember here in Scotland is UK income tax rates only apply to savings and dividend income, and then you're subject to the Scottish rates of income tax. So if I just remind you all on those Scottish rates of income tax, there's a lot of rates and there's a lot of bands. So it is more complex when you're in Scotland. Positively, Kate Forbes back in January did not increase those income tax rates. And again, I would anticipate a similar hold on those income tax rates until we start to re-emerge from this crisis. Just to pick up, if you are operating your business within a company, remember you do have that, it's not tax-free as such, but it is a tax rate of 0% applies to £2,000 of dividends that are extracted from your company. So it's worth bearing that in mind. You can get that out without a tax cost, but it is taken into account when working out your total income and what tax band you fall into. Okay, employment taxes. I know I'm whipping through these, but a lot to cover. Employment taxes, class 1 NIC. So again, the NIC thresholds, they will increase by Consumer Price Index for 2021-22 year, but then we're going to see those hold. So basically the level at which someone will need to start, an employee will need to start paying 12% national insurance rises to £9,568. So over and above that, you'll have to start paying, or the employee will have to start paying employee NICs at 12%. And then the rate at which the employee NICs reduce back down to 2%, that's when you're earning over £50,270. So again, these are being frozen. The threshold increases until April 2026. So all in all, this drag on rates and thresholds will generate, the Treasury thinks, 19 billion. So ultimately, we will all feel this in our back pocket to some degree or another by the time we hit April 2026, as we're paying a bit more tax than we otherwise would have been. Okay, the coronavirus job retention scheme, you know, this has very much been a lifeline to certain sectors, and in particular the hospitality sector. You will all be aware, I'm sure, of how this operates. What we did find out back in December is it was going to be extended to the end of April 2021. And in the budget last week, the Chancellor said, look, this scheme is staying around until the 30th of September 2021. So that's good news. It's going to see us through the period up to 30th of June 2021, broadly on its standard basis of 80% of salary will be covered if your staff member isn't working, up to a maximum of 2,500 per employee. Then the shape of this scheme is going to change, probably because we're hoping to all be let out, if that's the right word, by July. So, and hopefully before July, that's what I'm banking on anyway, and I've booked my staycation for May, so fingers crossed. From the 1st of July, we'll see the level of grant reduce, and employers will start to be asked to contribute a bit more. Okay, so if we look at the detail of that, essentially for the month of July 2021, it'll be 70% of furloughed wages will be covered if your staff member isn't working. And then for August and September, it will be 60% of furloughed wages. And that'll be up to a maximum, therefore, of £1,875. The maximum, sorry, for the month of July will be £2,187. Employers throughout this need to continue to fund the employer NICs and the mandatory minimum auto enrolment payments. Okay, and also a point to note, if it applies, and it might not in terms of your sector, but if you have had an employee who has made a real-time submission, a PAYE real-time submission for them between 20th of March 2020 and the 2nd of March 2021, then actually you can start to be eligible for that employee from the 1st of May 2021. Before going on to talk about national living wage and national minimum wage thresholds, it's worth remembering that, you know, there are quite specific apprenticeship programs available in Scotland. And I know that sometimes, again, we hear about some great apprenticeship scheme through the budget announced for England, but it doesn't apply up here. But the equivalent, I guess, is this Apprentice Employer Grant. It was released for hires, New Start hires on and after the 1st of December 2020, and it's open up until the 25th of March. Whilst the funding remains, the pot is 15 million for this. One thing I would say is maybe you aren't in that position to think right now of hiring, but again, if there's pent up demand, this may be something to think about. And essentially it looks like £5,000 you get if you're taking on or upskilling a 16 to 24-year-old through a modern or graduate apprenticeship. And then it's 3,500 for an employer taking on or upskilling any individual aged 25 or over through a modern or graduate apprenticeship. In terms of, the national living wage, it's worth noting that this has now been extended to 23 and 24-year-olds, and that could catch out some employers. Employees in this category, if they were on the national minimum wage, are currently being paid £8.20. But as you'll see from 1st of April 2021, that's becoming £8.91. So again, more costs obviously for business to manage, and again, even more need for government support to help us exit this crisis. I thought I'd just touch on again the upsides. If, for instance, you have fans and you're considering zero emission fans, from the 6th of April 2021, a nil rate of tax will apply to that fan benefit charge. So that basically means your employee can use that fan for private use. That's quite nice for them. And provided it's a zero emission fan, there's no charge. This is a return to what the policy was between 2010 and 2015. Again, employer provided cars, it's probably the last thing in your mind right now, but it's worth thinking if you do actually need a new set of wheels as such. You know, over the last decade or 10, 15 years, we've seen employers move away from the company car. So people who operate in a corporate structure move away from the company car. It was getting too expensive, but actually now with electric cars, the UK government has made it quite favourable. to basically have the company acquire that car, and it's a very low benefit in kind. So it's going to be 1% of the list price of the car from 6th of April 2021 and 2% the year after. So again, it's worth just thinking outside the box if you're making these types of purchases within your company. And that's just a list of how it works. You know, worst case scenario, it's a 37% on the list price if the CO2, the grams per kilometre, over 165. Okay. These are just a couple of quick ones. Again, might not impact, but if you do have employees with that cycle to work, there's a dispensation. You know, we get that people can't cycle to work at the minute, so there's no impact of that, essentially, no benefit in kind, and that'll continue up until 6th of April 2022, even though they're not cycling to work, but they're cycling everywhere else and enjoying the countryside, hopefully. Again, if you're in a business, and I can imagine this as businesses start to reopen again, there might be a need to have these various coronavirus tests, the antigen test. Again, you can pay for that for your employee and there's no impact. And again, if you have some staff who are working from home, they're doing their finance or their office duty roles at home, again, the employer can reimburse for relevant home office equipment. And there's no benefit in kind impact to that. Okay, so business tax. Yeah, coronavirus loan schemes. You know, funny, I was just reading this morning, announced on Scottish Government website, there has been 533 million paid out to Scottish businesses since the introduction of the strategic framework on the 2nd of November. Now, I know from Marc, there's a lot more still to do. This has been greatly appreciated, but actually now as we go to reopen our businesses, we need money now to help us gear up to reopen. So one of the announcements in the UK budget, which does apply UK-wide, is the recovery loan scheme. So I just wanted, first of all, to remind you all, there is 3 existing coronavirus loan schemes in place. These are all in place until the end of March 2021. So if you haven't looked at be it the bounce back loan or the coronavirus business interruption loan scheme or the large business interruption loan scheme, these are still around, but come the 1st of April as such, they are being replaced by the recovery loan scheme. And this scheme will essentially give lenders a government-backed guarantee on 80% of loans being made between 25,000 and 10 million. Okay, not all the details out there in this yet, and we don't know yet practically how friendly the banks will be to this, but we know the pressure will be on them, and the government are going to release the list of accredited banks that will be offering this. It's open to all businesses, so even if you've already had some of the other loan scheme benefits, you can still apply. It launches on the 6th of April and it's open until the 31st of December 2021, and they may extend it, they said. You'll be eligible if you're trading in the UK and if you've been impacted by the pandemic. And no personal guarantees will be required for lending facilities up to $250,000. Okay. If you are a non-incorporated business, so you're a sole trader or you're a partnership, then you are probably familiar with the self-employed income support scheme more than maybe the job retention scheme. So this is for the owner of the business as such, when their income has dropped, to get support. Positively, we knew there was going to be, you know, a further round of this, but we didn't know the details. But we've now got the details for this 4th grant. And it will cover the period, the 3-month period from the 1st of February to the 30th of April, and it can be claimed from late April. The revenue will approach you, but do be aware of these scam emails. The revenue will approach you and tell you if you're eligible. And provided you filed a tax return to 5th of April 2020, now that has to have been filed before the 3rd of March there, just passed. It's late now at the minute, but that has to have been filed to be eligible for this. So essentially this will again, you know, provide a single payment capped at 7,500. Okay. And it's also possible, this is the first time basically people who were not running a self-employed business prior to 2019, this is now the first time they can get within these new conditions. Okay, so for new setups, this is very important for them. And also, it's just to say the 5th grant has also now been announced, and it will be determined on how much your turnover has been reduced. So it's going to operate different. It's going to look at how much is your turnover reduced in the year April 2020 to April 2021. Now, if it's by more than 30%, then you're going to get 80% worth of your 3 months average trading profits, again capped at 7,500. However, if it's dropped by less than 30% your turnover, then it's going to be only a 30% grant capped at 2,850. Again, more details will follow, but this is basically to mirror self-employed support up to the end of September, similar to the job retention scheme. Okay, business rates, just briefly, I touched on them at the start. It's devolved obviously in Scotland, Northern Ireland and Wales. And actually it's more generous here versus what was announced in the UK budget, because Kate Forbes has extended it to 31st of March 2022. And that was very welcome. Okay, on to corporation tax. So again, this applies if you're operating as a company. It's a 19% rate currently. That rate is going up from April 2023. It's going up to 25% for companies with profits over $250,000. And if your profits aren't over that, first of all, if they're under 50,000, it'll be unchanged. The 19% rate will still apply. If you're in between 50,000 and $250,000, then there'll be a marginal rate worked out. Okay, tax losses, I'm getting there. Jen's just told me I have 2 minutes left, so we'll see how far we can get. This is quite positive. This applies for either if you're a sole trade, operating as a partnership, or operating as a company. You can essentially look to carry back losses over more years. So if we look at, for example, the company scenario, you can carry back for 1 year if you can't use it in the current year, but this will let you carry back a further 2 years. And so the same applies if you're operating as a sole trader. And so if we think about what I'm about to go on to, this super deduction, the capital allowance announcement that you are maybe aware of, you could find yourself, if you think, well, actually, I do have some cash here, I do need to incur some capital spend, you could incur that spend and then carry back the loss and an increased loss that has potentially arisen, given what's gone on the last year, against earlier years' tax paid and get cash back, okay, to offset the cost of the capital spend you're about to make. Okay, so the super deduction, this is what the Chancellor announced as, you know, the biggest business tax cut in modern British history, okay? And we now have a capital allowances regime at the minute that's the most competitive in the world. So between the 1st of April 2021 and the 31st of March 2023, please note this is companies only, you can get 130% deduction. So on most new plant and machinery you acquire. So, you know, that might be a lorry, a van, other qualifying plant and machinery that would normally get written down at an 18% rate. So essentially what it means in tax terms is for every £1 you spend, you're getting 25p back. And there's no spending cap on this. Now, for unincorporated businesses, they can't get this, but what they can get still is the annual investment allowance, and that gives you 100% deduction, tax deduction in the year you incur it. And that's remaining until 1st of January 2022. So not only have we this super deduction for companies, but also if you're like investing in heating and lighting systems, what we call integral features that usually get a 6% writing down allowance, they're now going to get a 50% writing down allowance for the next 2 years. So I would never say spend for the sake of saving tax, but if it commercially stacks up, then these are generous reliefs and should be considered along with the loss relief provisions. And actually, when you crunch your numbers, you know, your capital spend that you possibly have to make anyway could be mitigated. Okay, so I think I've just ran over by a minute. Stamp duty land tax, yes, that applies to England and Northern Ireland. It doesn't apply up here. They've got a more generous lift here on that side of things, because this is going to stay around to the 30th of June 2021. We're up to $500,000 is in that nil rate band. Whereas in Scotland, we've got land and buildings transaction tax, and that's set to return to its normal level on the 1st of April 2021. Okay, that's me. I'll stop sharing.
Great, thanks, Alex. Tony, over to you, please.
Thanks a lot, Alex. It's really interesting to hear about the direct tax side of things for people and businesses, but I'm going to focus on VAT for my sins. I'm a VAT specialist, and VAT, I've got the benefit of not having to worry about a UK and a Scottish VAT rate. Right now it's one tax, so I thought there was a couple of interesting points from the budget that would be worth discussing today. Just give me 2 seconds. I'll get the slides going. So I think the main things that I thought would be worth covering today would be the extension of the 5% reduced rate for VAT for holiday accommodation, hospitality and attractions, the updated VAT deferral period, and also, not strictly speaking budget related, but I wanted to comment on monthly versus quarterly VAT returns. So this was one of the main headlines from the budget last week. The 5% reduced rate VAT, what does it apply to? Well, currently it applies to hotel and holiday accommodation. So that includes camping and pitches, and it's your B&Bs, guest houses, hotels, and also covers hospitality in terms of restaurants and cafes, takeaways and bars. Not alcohol, unfortunately. But also it covers admission to certain attractions such as tours, gardens and shows, essentially the admission charge that you pay. Now, in terms of this reduced rate of VAT for this sector, there's been quite a lot of change, as you'll see on the screen just now. Essentially, up until the 14th of July last year, 20% standard rate VAT applied. And then at the start of July last year, it was announced we're going to have the 5% reduced rate of VAT, and that will be temporarily introduced from the 15th of July 20 to the 31st of March 21. So that was good news for the sector, and ultimately people were thinking, well, what's going to happen next? Will we revert back to 20% or not? And it was announced last week that the 5% reduced rate would be extended until the 30th of September. And then from the 1st of October, for 6 months, essentially there's going to be a new VAT rate of 12.5%, which will apply. And then from the 1st of April next year, 2022, it's going to be going back to 20%, or at least that's what the plan is. Now, what does this really mean in practice? Well, I've got my opinions just like you all have your opinions. Many hope for an extension, and that's what was given. The 5% has been extended for a few months, which on the face of it is welcome news. And in turn, there's going to be the 12.5% middle ground, as I would call it, which will apply for a further 6 months, which is, again, I suppose that could be good news. But some did hope that the 5% reduced rate would be made permanent by the Chancellor. Unfortunately, that wasn't to be, at least last week. And we now seem to have some certainty in what it will look like going forward. And I suppose it would be prudent to, budget and forecast accordingly on what has been said and laid down last week. But what does it mean for you in practice? How do you go about operating your businesses with this in mind? Well, I think it's just worthwhile covering off some, what I would call basic points, but it is things that were normally asked or quite frequently asked by some businesses. But just for the avoidance of all doubt, you're obliged to account for VAT to HMRC at the prevalent rate. HMRC don't really care if you say, well, my product is £10 and I'm going to add the VAT on top, or I'm going to take the VAT from that £10. Essentially, you've got the choice as a business to either preserve your prices and pay less VAT to HMRC, or you can adjust prices to pass on all or some of the VAT reduction that has been enjoyed over the past few months and will continue to some extent. Ultimately, it's your choice to make that judgment call on whether or not you pass on the VAT saving to some degree or not. And everyone will have a different view on that depending on their own fact pattern. But it's worth, just clarifying, well, when do you work out what VAT rate applies? Because from a couple of slides ago, we've seen 20%, 5%, 12.5% mentioned. When do we actually know what VAT rate applies? And essentially, it's all about tax points being the legal jargon, which is normally the earlier of receiving a payment or issuing a valid VAT invoice. So, for example, if a customer books a stay today and the stay will happen next Easter, 5% VAT is due to HMRC. It doesn't matter that between now and then we'll have 2 different VAT rates. You've created a tax point for VAT purposes, and as such, 5% VAT applies to that situation. It's interesting to see what we do in practice with this. You know, how much VAT do you actually pay to HMRC? Well, assuming that you've always charged £120 a night for a stay, including VAT, and this could easily be replaced with you've always charged £12 for a burger and chips in your cafe, or whatever it might be. It's the same principles. Before the 15th of July last year, 20 quid of the 120 went to HMRC as VAT. Since the 15th of July last year to you know, essentially the 30th of September, and there's a little typo in there, you'll see in the slide in the second bullet point, that should be updated to the 30th of September, you're going to pay over £5.71 to HMRC. And then from the 1st of October to the 31st of March, you're paying £13.33 to HMRC. And from the 1st of April next year, you're paying over £20. So that's how it looks if you've got a situation where we charge X amount for our product and we pay HMRC VAT from that amount. And you'll see quite clearly there are some variances, quite stark, between the 5% and the 20%. And ultimately, I suppose it's you as a business that's got the choice. Do we want to retain, you know, the same price? Do we reduce the price? Do we go somewhere in between to reflect our costs? It's really up to you, but I thought that slide would be useful just to draw out what it looks like in terms of practically paying VAT when the 5% and in turn 12.5% applies. Assuming you don't take anything to do with you know, the VAT fractions, you've just got your price for your product. So for example, you charge £100 for an overnight stay, and that's the net price. Well, you really just have to apply the VAT to that. So you used to charge £20 of VAT. You're now accounting for £5 of VAT. You'll start accounting for £12.50 of VAT, and then you'll go back to £20. That's what it's like if you don't, you know, adjust your pricing in terms of the VAT fraction side of things, if you just purely add VAT on to your net value. And again, it's your choice what you do. Now, moving on very quickly, I'm going to cover off the VAT deferral period. This will be applicable if you're a business that normally pays VAT to HMRC, and last year you took advantage of the VAT deferral period. Essentially, the VAT deferral period allowed most businesses to defer paying the VAT due on one of their VAT returns last year. And the idea was, well, you can take advantage of this if you pay it by March 2021. And many businesses did sign up for this. A few months ago, HMRC and government, fairly quietly in the big scheme of things, announced an update to this scheme. They announced that you could use the original plan, pay by March 21, or you could use an alternative where you extend and kick the can down the street for a further year in terms of the full amount being repaid. Because essentially now you've got a second option where you sign up to pay back in installments. And it could be you make 2 installments, it could be that you've got 10 installments, but ultimately you can agree with HMRC by logging onto their website to pay in installments rather than paying them a lump sum this year. And with time running out, it's seen as prudent for many businesses to consider this. There's a cash flow benefit, you know, you're not having to pay that lump sum. And there's also things like banking covenants, the discussion with the bank manager about, you know, your funds. This just gives you a little bit more breathing space if you did defer that VAT payment. And the portal is now open if you would want to sign up for the new option. If you're a different type of business that is always getting money back from HMRC in principle, a regular VAT repayment position, you could submit monthly VAT returns. It's almost assumed by HMRC and VAT practitioners sometimes that if you're entitled to this, people would know about it. But there's no harm in flagging this, because essentially, if you're always getting payments from HMRC, you can say, I don't want to submit quarterly VAT returns anymore. I want to submit monthly VAT returns. The downside is you've got 12 VAT returns versus 4. But the upside is that you're suddenly in a position to claim back VAT every month from HMRC. So you don't need to wait 3 months in the cycle to get your money back. You can get the money back every month. So that's quite a good benefit for many businesses that are in a repayment position. And within the sectors that are involved today, I suspect there will be some people that are in a repayment position, and there might even be some that aren't on monthly returns. It's certainly some food for thought. You need to do the cost benefit analysis to work out, is this right for me, admin versus the cash flow benefit? But if you go for it, you can, again, easily sign up on HMRC's website to update your VAT return stagger. That was a very, very quick whistle-stop tour of the VAT updates I wanted to share. So what I'll do now is I'll pass you over to David, who's going to give some updates from a financial planning perspective.
Thanks for the update there, Tony. I'll just share my slides here. I thought the government was making tax simple as well, but that certainly seems quite complex. But yeah, anyway, the next section is just really a budget update from a financial planning perspective. And my name is David Watson. I'm based in our Perth office. I'm a chartered financial planner, and I work with Johnston Carmichael Wealth, who is the independent financial advice and wealth management arm of Johnston Carmichael. So the first thing I was going to look at was pensions. There's really two things to consider with pension planning. There's those people in what we call the accumulation phase who are building funds up for retirement, and those who are in the drawdown or at retirement phase, where you're actually hopefully enjoying the fruits of your labour. So starting with the accumulation phase, there's no change to any of the tax reliefs on contributions into pensions. Some of you might be aware that you get tax relief on contributions into pensions at your marginal rate. So in Scotland, whilst we pay slightly higher tax rates at 21, 20, 41 and 46%, we actually get the benefit of higher tax relief going into pensions as well. So there's no changes there. Likewise, there's no changes to company contributions, which are still allowable as a deductible expense against corporation tax. The annual allowance, which is the amount you're allowed to pay into a pension and claim tax relief, that's called the annual allowance. That again remains at 40,000 for the coming tax year, and you are able to claim carry forward potentially up to 3 years previous year's allowances. That typically is only useful for somebody who comes into a windfall and wants to try and put a chunk of money into their pension at one time. And finally, in the accumulation phase, there is something called tapering for higher earners, whereby the annual allowance of 40,000 is reduced down to 10,000, and the threshold income for those higher earners remains at 200,000 and adjusted income at 240,000. So again, no changes there. Looking at retirement next, so when you come to draw down your benefits, there is what's called a pension lifetime allowance, which is essentially the amount of benefit that can be drawn down from pensions before you trigger an additional tax charge. Previously, this was at 1.8 million, and successive governments have brought that down to £1 million in recent years, and it has been increasing with CPI and was supposed to continue to do so, but they've announced they're going to freeze that for the next 5 years. It's not a very nice number to freeze it at 1,073,000, but that's the pension lifetime allowance, which probably doesn't affect that many of us, in fairness, anyway. Also, the money purchase annual allowance, which was introduced back when pensions freedoms were introduced, and this limits the amount of money that can be contributed to a money purchase pension once you've actually started accessing a pension flexibly. So that remains at £4,000 again for the coming tax year. Next up, looking at investment allowances, the popular savings vehicle. So ISA allowances, most of you may be familiar with ISAs, which are a vehicle for saving money tax-free, so you don't pay any capital gains tax or income tax on gains. and the allowance there is remaining at £20,000 per annum per person. In addition, the government have, this is not a new thing, but it's been introduced a few years ago now, the lifetime ISA allowance, which a lifetime ISA is in addition to your main ISA allowance, and it's aimed at people under the age of 40 looking to build up deposits for buying property. And so essentially you're allowed to pay £4,000 into a lifetime ISA, and the government will top that up by £1,000, giving you £5,000 for your 4,000 invested. And as with all ISAs, you can either put your money into a cash ISA where it's in a bank, and just now clearly you're not getting much interest, or you could invest the money, hopefully get better return. But if any of you out there have got children who are over the age of 18 and looking at saving money for deposit for property, lifetime ISA, it's certainly worth considering. And the junior ISA allowance as well, that's now up to £9,000. Well, it remains at £9,000. It was increased a few years ago as well. And that can be a useful vehicle for potentially for grandparents doing inheritance tax planning. So next, I was just going to look at inheritance tax quickly as well. We've got the nil rate band, which is the amount of your estate that's free from inheritance tax. That's frozen at 325,000. It's now been frozen at that for, I think, 11 or 12 years, and it's going to be frozen for the next 5 years until April 2026 at least. So no change to that limit. It was again supposed to be increasing by CPI, but they've backtracked on that and now freezing it. And the residential nil rate band, which this is an additional amount that can apply to property owners. Relatively new in the inheritance tax landscape, although it's been around probably 4 or 5 years now. And broadly, this is the residence nil rate band is available if a person's estate includes their main residence, which is left to children or other direct descendants. So, and that's remaining frozen at £175,000 per person. And the inheritance tax rate itself, that remains unchanged at 40%. So essentially, if you die and leave an estate greater than these thresholds that we mentioned, then you'd pay 40% tax. Unless, of course, you leave some money in your will to charity. If you leave more than 10% of your estate to charities in a will, you can actually reduce that tax rate from 40% down to 36%. So that was a quick run through from financial planning side. Essentially, there's not really any great changes there at all, apart from the allowances being frozen rather than increasing with CPI. The other thing I was asked to do was just give a few planning ideas or considerations for agritourism members. So firstly, looking at protecting your family business or your family and your business. There's 3 things I'll look at here: shareholder protection, key man protection, and relevant life cover. If we start with shareholder protection and maybe trying to bring this life, you imagine there's a business was owned by 2 brothers, so we'll call them William and Harry, and let's say, unfortunately, they both own 50% share in the business, and sadly Harry dies and his shares are left to his wife, in this example Megan, and Megan doesn't want to be involved in the family business. William's potentially now left in a predicament where they don't have capital to buy her out of the business. So shareholder protection essentially would, in that scenario, mean when Harry dies, a lump sum of money goes to the business, and that can then allow William to buy Megan's shares. Megan can then depart the business and go off to Hollywood if that's where she wants to go, and William can move on with the family business, and hopefully there's no disruption there. So that's shareholder protection. Key man protection is another thing that's potentially worth considering for your business. Again, depends on the type of business you have. But if you've got a key person, for example, operation person or any key member of staff, really, they don't need to be an owner in the business or a director in the business. But if you've got key members of staff who you feel, God, if something happened to that person and they dropped down dead, our business would really be in the stookie, you can put in place what they call key man protection, which essentially would give your business, in that eventuality of your key member dying, a sum of money, which really can be used for any purpose. But the 2 key things really would be for cash flow whilst you try and recruit somebody else, and secondly, Potentially you could offer somebody a golden hello to come and join your business using the capital. So that was key man protection. Next thing is relevant life cover, which is quite an unknown area of life insurance. But essentially, if you've got a limited company, that your business is set up as a limited company, but you also have personal life insurance for potentially mortgages or just family life cover, you can actually set this up in what's called a relevant life basis, whereby your limited company pays the premiums for the cover, but the benefits still go to your family members. This can effectively, taking account for tax, can reduce the cost by about 30%. So it's something I tend to do if looking at a new client who's got trades with a limited company. We'd always look at reviewing any life cover they've got, making sure it's set up most efficiently. So that's just a quick look at some ideas for protecting your family and business. Some other things, if you've got family members, you're looking at saving funds for school or university fees, then ISAs that we touched on earlier, you're able to put £20,000 per annum each into ISAs, and any gains free from capital gains tax and income tax. And clearly, if your children decide not to go off to university, then ISAs are very flexible, so you could use the capital for other things, whether it's your own business or helping them start their own business or buy property. But they're a useful savings vehicle for that purpose. And looking at succession planning, again, I'm going to look at two things here quickly: pensions and whole of life policies. So starting with pensions, again, looking at a scenario here, let's say we've got a business which is owned by Charles, and he's got two children, William and Harry. And again, in this scenario, William's interested in the family business, but Harry's not. So Charles has now got the predicament whereby, does he leave the business to William and just let Harry fend for himself, or does he try and do something for Harry as well to try and make things a bit equitable? So one option there would be to use any existing pension funds, assuming he doesn't need them for his own retirement. You could build up a pension fund, which nowadays pensions can be passed on to children free from inheritance tax. And Charles could do that and build up a fund, which then could be left to Harry, and William gets the business, and that can try to make things a bit equitable. Another use of pensions potentially is buying commercial properties and land. So if you've got a self-invested pension, you can actually borrow, your pension can actually borrow money as well to buy land and buy commercial premises. This potentially could be a way of also easing cash flow for somebody. If you potentially own assets and you have a pension fund, your pension fund could buy the asset from yourself, which then gives you cash. Clearly, you'd have to look at capital gains tax implications, but that is something to consider. And some of the main advantages of doing this are the rent that gets charged goes into your pension fund free from income tax and grows tax free. And clearly the rent that your business is charged to occupy the premises is deductible against your profits, so you pay less corporation tax if you are in that situation. So that was pensions. In terms of the whole of life policy, again, this is, I guess, going back to the scenario of Charles leaving, trying to keep Harry in an equitable situation, and what he could do instead of paying money into a pension, or as well as, he could use the 3,000 gift allowance that everybody has, and use that to set up a whole of life insurance policy, which would be held in trust for Harry. So essentially how this would work, let's assume it was Charles and Camilla, and assume they were both 65 years old, both non-smokers. If they paid £3,000 per annum, based on the current providers, they should be able to get around about £130,000 worth of benefit, subject to underwriting. Effectively, that would be held in trust until the second of them dies, and at that point in time, the business gets left to William, and the 130,000 goes to Harry. And this is a mechanism that's quite common. I've seen this used quite a lot with farmers, where they've maybe got a son and daughter, and the son going into the business and the daughter's not. And this can be just a way of trying to make things equitable for the daughter without loading the son up with debt in the farming business. So that's just a few ideas, but I'm conscious of time. So I will hand back to Jenn Stewart here.
Thanks, David. So no, thank you very much to Alex, Tony and David for all their sessions there. So does anybody have any questions that they would like to ask? We have been keeping an eye on the chat function and answering as we go, but is there anything else anybody would like to ask? Well, what we'll do is we will share our slides.
Sorry, Jen. David, there is a question there. Did you answer the one from Neil about profits from the sale of a home downsizing?
Well,
can you pop that into your pension?
Yep.
Oh, sorry, Alex, I didn't see that question. What was the question there? So,
can you put the profits from the sale of a home when you've downsized into your pension, essentially?
Yes, absolutely, you can. Yeah, if you've got relevant earnings. So essentially, the way pensions work, the annual allowance that I mentioned of 40,000, you would need to have a net profit or salary of the equivalent level, and you can pay 100% of that level into a pension. If you don't have any income, then unfortunately the maximum you're allowed to pay into a pension is 3,600, which potentially is still worth doing. But yeah, hopefully that answers the question.
Thanks, David. Okay, well, I'm not seeing any more in there, but thanks, Alex, for popping that one in. So, so we'll share our contact details, and if anybody wants to contact us offline about any of the points that we've discussed or anything else, then please don't hesitate to get in touch. So, I will pass across to Caroline now, who I think is going to make some closing remarks. Thank you.
So thank you very much to everyone from Johnston Carmichael. That was really helpful. It was like one of these TED Talks where everything's very clear, very succinct. I know we had a short time, but it was very short and snappy, and there's lots of really good information there. And I think being able to share this afterwards as a record and let other people catch up is really relevant. So thanks for following up with us as well. I think you did, as you said, you've already addressed. I had a couple of questions there in the chat box, but they were addressed by the speakers. So I think, yeah, going forward, obviously, you know, we're all still shut down. We're all making our plans for coming out of COVID, but I definitely think, you know, that bounce back loan that was about a 5-minute job to get 50,000, if you could do the same for 250,000, I think, and it's that easy, I think there's going to be quite an uptake of that. And obviously, yeah, just the VAT position as well, things like that going forward. I mean, to get a permanent reduction in hospitality and tourism VAT, like other countries, would be fantastic. So yeah, thank you very much for your support, everyone at Johnston Carmichael, and we look forward to continuing to work closely with you both across Agritourism and also the wider Scottish Tourism Alliance. And thanks to everybody who's also joined us today. It's been a great session. Thank you.
Thank you.
Thanks all.